Continuing our discussions on options, right? An option price will frequently have a price that's greater than the intrinsic value. Why would that be true? Although I hate to talk about gambling, think of that here. If I buy a call, I'm betting that the stock price will rise. What is that bet worth? Well, the intrinsic value is the current value of the security, but there's something called the time premium. That essentially is what the bet is worth. And there are lots of factors that affect this time premium, but essentially, again, it is just the cost of the bet. So here we can see that at a $20 stock, the per share strike price is 50. So the hypothetical market price is 2 cents. Well, the intrinsic value is still 0, but you have to pay 2 cents to buy this bet. So again, essentially, you are betting that the stock price goes above $50. At $60, it has intrinsic value. But of course, the bet is now also going to have value. So the actual price of the option is $15. So the time premium, again, is this $5 excess. So what impacts the time premium, right? It depends on the time to expiration. Dividends could be involved, the volatility of the stock price, and interest rates. Those are all variables that have an impact on the value of the derivative. So this gray shaded area here, which shows the excess of the hypothetical price over the intrinsic value, that is the piece that grows. And as you can see, it is greater right around the exercise price. So again, as things change, as these variables change for a stock, that shaded area will grow. So if you're going to purchase a call for $10 with a strike price of 50, if the payoff is above 0 at a stock price, what profit is above 0 at a stock price of 65? So again, if we kind of look here, what we're looking at is the difference. What I want to explore here is the difference between the profit from buying the stock and the call. The gray line represents the profit line for the stock. If it's $50, the profit that you make on stock is anything above that $50. At $65 right in here, that's where the stock price is essentially 0, right? The profit is 0. Above 65, you make money. Below 65, you don't. But if you were to buy this option for $10, it will start making profit when it gets to the strike price, but it itself won't get to a positive profit until it also recovers the entire premium that was paid for that option. So let's look at another side of this transaction. If I'm buying a call, somebody must be selling the call. So the question here is, who creates this other side, right? Remember I mentioned a bet? Well, you have to place your bet with someone. Who is that person? Well, you'll never know who that is. All of this is done through what's referred to as a clearinghouse. But someone is on the other side of the transaction. So you need to note, as a buyer, you have limited downside profits. Right? If you are buying the stock, you pay the premium, and if the price goes up in the call, you make money. But you can't lose any more than the premium. This example shows the profit of a combined transaction. We bought a stock, or we own it, and we wrote a call. So again, if I buy a call, remember I'm betting the stock price goes up. So if you write a call, you must think the opposite, that the stock is at least going to stay where it's at, or maybe actually even go down. So when you write a call, you receive the premium. This is your amount. You can't make any more money than that. That is the entire profit line. Now, if you are wrong and the stock price continues to go up because you're betting it's going down, you're going to lose value. And what you can see here is if you write a call, you have a maximum profit, but you have unlimited loss potential. Now, it turns out that most calls never are exercised. If you own a call, and again, you wrote this call, and things really started to go down and you wanted to get out, all you would do is go out and buy the exact same call. So you would actually have written a call and you bought a call. They're equal, so your losses, your transaction is now zero. If you were to write a naked call, that means you don't own the stock. As you can see here, the maximum profit is the premium. So if you're wrong, again, you have this unlimited loss potential if you have a naked call. What's the difference between the two? If you have a covered call, you own the stock. So if the stock price is going up and your call value is going down, they net out to zero. There'll be zero profit above a certain level. If you don't have that stock to cover your mistake, then you are subjected to all of this extra downside potential. What about the profit of a put option? You're going to purchase a put for $8. It has a strike price of 30. If the stock price is strike price is 30. If the stock price is 20, then you could purchase the stock on the open market for $20. You could exercise the put, sell it for $30, and your profit would be $10 minus the $8 premium for the put, or you would have a net profit of $2. So what does this look like in a diagram? Again, we have a stock price of 20, exercise price is 30, and the premium is 8. So if you buy this option, you have $8 in the premium. It is a put, so you're betting that the stock price goes down. If the stock price starts to go down, your put starts to make money. It starts to gain profit. Once it gathers all of the premium, that is, it would have to go down to $22. If you see here, right around $22, there is zero profit. Anything less than $22 would be net profit to the person who purchased this put. Now, the person that wrote the put, again, has the opposite idea of what's going to happen. They think the price is going to go up. They would receive this $8. Now, as the $8, as it started to go down from 30, the strike price down, you would, or they would, start to lose part of that $8 till it got to 22. Then they would actually have zero profit. They received $8, but they've lost $8 on the stock, so they're at zero. But if it continues down, they have continual losses, clear down till the stock price will get to zero. So how do we compare puts with short sales? If you think about the price is going to go down, again, you can make money by selling the stock short or by purchasing a put. there is limited potential loss by purchasing a put because you can only lose that amount of money. Puts offer greater percentage returns due to the leverage. Now, the benefit to a short sale is it doesn't have an expiration date. So we could wait a while for the price to drop before we would have to worry about losing any of our investment dollars. What is a protective put? This is where we're going to take a long position in the stock and we're going to purchase a put. This strategy can be used if you have some profit and you want to protect it from losses. So a good example might be an index mutual fund. You have a very large investment in the S&P 500 and you have some substantial profit. You want to protect that against any type of collapse in the stock market. If you buy a put on the S&P 500, that put will make money if the stock price goes down or if the index goes down. If the index goes up, obviously this put goes to zero intrinsic value. You would lose the premium that you paid, but you would not have the losses that you had otherwise. So the trick here for these types of hedging strategies is you need to try to equally match the investments. Most larger mutual funds with large equity portfolios, they try to match an index to their particular equity fund as best they can. So they will rarely have a perfect hedge, where if you were just protecting one stock, this would actually work quite easily. Now, lots of people may do this for short time frames, but I think a lot of more institutions are heavily into this hedging kinds of activity. What's the difference between a protective put and a stop loss order? Remember, a stop loss order is a standing order to sell the asset when the price goes down. That limits losses of owning the stock. Now, the stop loss could cause the stock to be sold. So now you no longer have the investment, but a put leaves the investment there and it just offsets the loss. So the disadvantage of a put is it expires and another is going to need to be purchased in order to keep that position. So how can we use options to look at investor sentiment, right? If the market believes the stock prices are going to rise, that means people want to buy the stock. So they have what's referred to as the put-call ratio. This is the number of puts divided by the number of calls. If this ratio is 1, we have the exact same number of puts and calls. Essentially, we're saying that investors are indifferent. They don't think it's necessarily going to go up and or down. If this ratio is more than 1, that means there's more puts than calls. Less than 1 means there's more calls than puts. So how do we use this? Are investors more often correct or incorrect? The idea here is that investors are frequently incorrect. So this is what we might refer to as a contrary measure. If more people are buying calls, it means investors are very bullish on this instrument. That could be a sign to sell because we know investors, individual investors, are wrong most of the time. So this is a market kind of a movement, even if you're looking at stock index options. We could imply something about the stock market. And certainly you can imply something about an individual stock if you have its put-call ratio. Look forward to talking to you in the next video.